Hi, everybody. This is Kevin Gormley, CFO of Leading Edge Financial Planning. And today I wanted to talk about the returns in Q3 of 2016. Two caveats. First caveat is that short-term investment returns are meaningless. So why do we discuss them? Well, the reason why we discuss them is that sometimes there are some messages that we believe we can take out of data. So data itself, boring. It's only exciting if it's good. And so we think there's messages that you can take away, learnings, if you will, from market movements. And so the messages I have today are that number one, size matters. We've talked about the fact that large, medium, and small companies in the U.S. and the world, it does matter if you invest in large versus small. And I'll show you some data that backs that up. The value tilt. Buying companies that are not considered the great growth companies did very well in developed markets this past quarter. World investing, you'll see that outside the U.S. did much better than the U.S. In 2003 Q3. And then sometimes what makes sense to do, this is called the narrative fallacy. Okay, so we get a story, it sounds like a great story, makes a lot of sense, but the investments don't seem to go along with that story. And the reason for this is that there's an efficient market. And if you believe or don't believe in the efficient market hypothesis, all it means is that all the news that's out there, we already know. And so people make stories about what we know right now. That's already priced into the price of stocks and bonds and everything else. It's the things in the future that we don't know what's going to surprise the market and what news will come out after tomorrow. And so that's the reason why it's so hard to figure out what's going to happen and pick the right companies. So I have a little article that's picking on Goldman Sachs, but it really could be any investment company. It's not just Goldman Sachs. They're very smart people. So here's without further ado, here is the market summary for Q3. U.S. stock market was up 4.4%. International developed, which is the rest of the world but not emerging markets, was 6.29% increase in the quarter. Emerging markets were the star of the quarter, up 9%. Global real estate, U.S., I think it's U.S. real estate, but we'll see the numbers, actually did very poorly in Q3, not very poorly, down 0.25%. In the last month, though, real estate has been down big. So this might actually be a buying opportunity to start just dipping your toe in a little bit of real estate, global as well as U.S. And then the U.S. bond market, world bond market were up a negligible amount, but they were positive. And so overall, if you were invested in stocks and bonds and real estate, you had a pretty decent quarter. So as we always like to do, Charlie and I, again, this is a teachable moment. All the news that came out in July and August and September, some of it was horrible news. Some of it was great news. We think, well, the news comes out, something bad happens, we should sell. Well, sometimes that does happen for a week or two, but then the market continues higher. Now, this one here is the last number of years. You can see here 2000 to 2016, and the piece that's in here is just the last from September 2015, so the last year. And so again, market's been overall higher. Now, we don't know if the market will always continue to go higher, but as long as things don't go bankrupt and companies continue to earn and return money to shareholders, you would think it might. So here's the big first message. Russell 2000, all that means is small companies. Small companies did the best in 2003. Emerging markets, you see second. The small value did extremely well as well. That's Paul Merriman's favorite asset class, who we follow. And then you can see the rest of the classes, small, ex-US. So the small companies in the rest of the world did better than the large companies in the rest of the world. You see the S&P 500 down here, global REITs. This is ex-US, so this is foreign REITs. So foreign REITs did well, and US REITs did poorly. So anyway, that's the returns by asset classes. Now let's look at a little bit more in depth in the US. Small cap trounced large cap, double the return. And again, we think you should own smaller companies, and these are companies that you don't know most of the time. They're not the big bellwethers, but small companies have outperformed. As far as growth and value, it was for the large companies. It was pretty much across the board that they all did okay. Value actually in the U.S. had a little bit worse performance. Developed now, we see that value and small, boy, that's the DFA, that's the family and French model there. And again, it's just one quarter. It doesn't really mean anything statistically, but that's one of the messages that we have for investors is invest in value, overweight in value, overweight in small, and continue to be invested regardless. So one little statistic here, 37% of the investments are now in the developed world. The developed world has been beaten down a bit. So emerging markets, after years of us struggling and clients asking, why are we in emerging markets? And again, the last 3-year return for large cap emerging markets has been negative 0.5%. We finally have a year to date, which is pretty spectacular, 16% for the largest companies here. And so in Q3, large did better than small, but everything, and this is in US dollars, the darker gray, everything did well. As far as country performance, probably not that important, but anyway, they put it in here. People like to look at the country. Austria was the #1 ranked developed, and Egypt, which seems like it had tons of problems in the last number of years, was the #1 ranked emerging market. Real estate investment trusts. These have had returns the last 10 years that are very similar to stock returns. You can see that 41% of REIT market is in US, 59% is outside the US. And we do have funds that we can hit both of these areas, both inside and outside the US. And the dollar will obviously make a big difference. And that's one of the reasons why the global real estate ex-US actually did better. The dollar helped us this time around. And U.S. REITs were down, and again, they were down big in the last couple weeks. Commodities, you can see across the board, oil was down, natural gas was down, but in the last 5 days, boy, they've really spiked up. So fixed income is the last slide that I will show you, and then I'll show you that story about Goldman Sachs. So fixed income across the board had pretty good returns. Year to date, everything is up. Year to date, long-term bonds have done extremely well, but I would not take the risk of investing and then have interest rates go up and crush them. High yield corporates, so the high yield bonds, junk bonds, actually up 15% this year after a very tough year last year. So let me show you the Goldman Sachs article that I saw this morning on Bloomberg. And so in a nutshell, what this article from Bloomberg is saying is that Goldman Sachs, they should have bought the stocks they hated. So Goldman Sachs came out at the beginning of the year and they said which stocks they should buy. And they have their own little fund and they have their own little recommendation list. And on this recommendation list, they have Facebook, Amazon, Google, as well as companies like Visa, JP Morgan, and Salesforce.com. Well, it's not been good this year. And the outflows of the funds, they're losing money, and again, it's because they're doing poorly. Now, probably the best time to invest in this type of strategy is when it does poor, and that's the whole part of active management. That's just time and time again, you have to apologize when you use active management because you always zig when you should have zagged, and that's what happened with Goldman Sachs, arguably one of the best managers of money in the world, and they got it wrong so far this year. So again, we stick with buying markets, and we thank you for watching, and if you have any feedback, we'd love to hear it. Thanks.